Chapter 3 looks at interest rates and security valuation. We're going to look at rates of return, basic bond valuation, basic equity valuation, and the concept of duration and as it relates to interest rate risk. Let's begin by considering some interest rate measures. First, let's take a look at the coupon rate. The coupon rate is the periodic cash flow promised by the bond issuer. It does not change over time. Here's a 7% coupon bond for Walmart with a 10-year maturity and a $1,000 face value or par value. The 7% coupon rate is multiplied by the $1,000 face value to determine the bond's annual cash flow or coupon. Again, this rate is set contractually and doesn't change over the life of the bond. Next, let's consider the required rate of return. That's the rate used by individual market participants to determine the fair market value of the bond or what they would be willing to pay for it. The required rate of return is essentially a nominal interest rate that's going to reflect the time value of money and any default premiums or other types of premiums associated with the company borrowing the money. Let's assume that investors are willing to lend money to Walmart at a 10% interest rate. In other words, they have a 10% required rate of return. Let's go ahead then and solve for the bond's present value or price. The first thing we can observe is since the coupon rate of 7% is less than the required rate of return, this bond will sell at a discount. If investors were receiving their required rate of return in terms of an annual coupon, they would be receiving $100 per year. Since they're not, the bond isn't particularly appealing at a par or selling at par, so it will sell at a discount. Let's go ahead and figure out that price. In your financial calculator, you would enter in for 10 years, 10% for the interest rate, $70 for the payment, and $1,000 for the future value. Again, the 70 and the 1,000 are both cash flows we will receive, so we want to enter those as positive numbers. When we solve for the present value, we see this bond will sell for $816. Again, it will sell at a discount. If we have a slightly lower required rate of return, we'll be willing to pay more for the bond. At an 8% required rate of return, we pay $933. And if our required rate of return is 7%, which is equal to the coupon rate, the bond will sell at its par value, or $1,000. If our required rate of return is less than the coupon, the bond will sell at a premium. So again, the required rate of return by market participants determines the bond's present value, or what we would be willing to pay for the bond. That is slightly different than a bond's expected rate of return. The expected rate of return is the return that investors can expect to earn by buying the security or bond at its current price. If a bond is selling at par, its expected return will equal its coupon rate. In terms of our financial calculator, we can solve for this by entering our present value as a negative amount. That's the price we're paying, and the payment and the future value both as positive amounts, and solving for the interest rate. Of course, if we pay more than $1,000, we pay a higher price up front for the same future cash flows, our expected return will go down. So if we paid $1,010 for the bond would be selling at a premium, and our expected return would be 6.9%. As we continue to pay higher prices, our expected return goes down. If we pay lower prices, our expected return goes up. At a price below par, our expected return will be higher than the coupon rate. We can't directly observe expected returns. Expected returns are observed or calculated indirectly from an observed market price. Finally, realized rate of returns. That's what we actually earned on an investment after the fact. Let's take a little bit closer look at the expected rate of return by working through a problem. Again, we can't directly observe expected returns. The market price of a bond will determine our expected rate of return. So the BS Corporation has a $1,000 par value bond with a 5.8% annual coupon, 4 years until maturity, and it's currently selling for $9.75. What's the expected return? Let's take a look at the cash flows from this bond. A 5.8% coupon rate means the annual coupon on the bond will be $58 per year, and the bond matures in 4 years. The current price was $9.75, so notice it's selling at a discount, which means that our expected return will be higher than the coupon rate. If the bond was selling at par, our expected return would equal the coupon rate. And of course, as bond prices go down, interest rates, or in this case our expected return, will go up. In your financial calculator, again, the payment as well as the face value or future value that we receive in 4 years, those are going to be cash flows that we're going to get. We want to enter 4 for the number of periods, $9.75 for the current price, and we're going to solve for the interest rate. And we find this bond has an expected return of 6.53%. Again, if we paid $1,000 or the par value for the bond, our expected return would be exactly equal to the coupon rate. If we pay more than par, our expected return will be less than the coupon rate. First thing we observe is since our required rate of return of 6.5% is greater than the coupon rate, this bond will sell at a discount. To solve for that, again, we enter the payment and the future value both as positive amounts in our financial calculator. 4 for the number of years, 6.5% for the required rate of return, and that allows us to solve for the present value of $976. Again, that's what it should be selling for if investors have a required rate of return of 6.5%. If we had a 5.8% required rate of return, the bond would sell at par. If our required rate of return was less than 5.8%, this bond would sell at a premium. So again, if we have a 6.5% required rate of return, we would be willing to pay $976 for this bond. If it was selling for $980, we wouldn't want to buy it because we would earn an expected return less than our required rate of return. For instance, let's say the bond was selling at $990. That would mean the bond has a 6.073% expected return. And if we require a 6.5% return, we would not want to buy this bond. And again, that makes sense because it's currently selling for $980, and we determined that its fair value would be $976. The bond is overpriced. Finally, let's take a look at our realized rate of return. It's the after-the-fact rate of return. What did we actually earn on our bond investment? Assume we bought a bond 5 years ago for $807, and it's now selling for $830, and it had a $50 coupon, which we reinvested. And again, that's sort of that assumption of our internal rate of return assumption. Let's calculate our realized rate of return. We don't actually need to do anything with that reinvestment assumption. It's implicit in our calculations. But let's go ahead and solve this problem. So here's our investment. We paid $850 for the bond. We've held on to it for 5 years, and we've received $50 a month in terms of annually for our coupon, and $830 is what we sold it for at the end of our holding period. Let's enter our pieces into our financial calculator. We held it for 5 years. We purchased it for $850. We received $50 per year and sold it for $830. Again, we need to make sure that our payment and future value, the selling price, both have positive signs in our calculator, and the $850 is entered as a negative amount. Then we simply solve for our realized rate of return. We had a realized return of 5.46%. Of course, this might be higher or lower than our originally required rate of return or expected rate of return. It depends on what's happened to interest rate in the marketplace, as well as that particular company's bond price.